Home-related tax deductions you can't afford to miss. Hi, I'm Robin with Modus Real Estate, and in today's videos, I'm breaking down the most important home-related tax deductions that could save you thousands. Whether you just bought a home, made upgrades, or have been paying your mortgage for years, these tax breaks can put real money back in your pocket. Let's dive in. Home-related tax savings, the basics. Before we get into specific deductions, let's clarify two terms: tax deductions versus tax credits. Deductions reduce your taxable income, which means you owe less in taxes overall. Tax credits provide a dollar for dollar reduction in the amount of tax you owe. They are much more valuable than deductions because they directly reduce your tax bill rather than just lowering taxable income. Itemized versus standard deduction. You can only claim most home-related deductions if you itemize instead of taking the standard deduction. For 2025, the standard deduction is $15,000 for singles, $30,000 for married couples filing jointly. If your total deductions exceed the standard amount, then itemizing is the better option. Key home-related tax deductions and credits. Number 1, mortgage interest deduction. If you itemize, you can deduct interest paid on up to $750,000 of mortgage debt. This applies to both primary and secondary homes, but not rental properties. Your lender will send you Form 1098 with the total interest paid for the year. Number 2, property tax deduction, SALT cap rules. You can deduct up to $10,000 in combined state and local taxes, including property taxes, state income taxes, or sales tax, whichever is higher. If you live in a high tax state, this cap might limit your deductions. Number 3, home equity loan and HELOC interest. Interest is only deductible if the loan was used for home renovations, a new addition, other substantial home improvements. If you use the loan for credit consolidation, vacations, or non-home expenses, it's not deductible. Number 4, energy efficient home improvement tax credit. You can claim a 30% federal tax credit, up to $3,200 per year for solar panels, energy efficient windows and doors, upgraded HVAC systems. This is a credit, not a deduction, which means it directly lowers your tax bill. Number 5, capital gains exclusion on home sales. Selling your home? You might not owe capital gains tax if you lived in the home for at least 2 of the past 5 years. Your profit is under $250,000 for single or $500,000 married. Big tip: keep detailed records of major home improvements. They can increase your cost basis and reduce taxable profit. Number 6, home office deduction, self-employed only. If you're self-employed, you may qualify for a home office deduction if the space is exclusively used for business, it's your primary place of business, and 2 ways to calculate it. Simplified method, $5 a square foot up to 300 square feet. Regular method, prorated portion of the rent or mortgage, utilities, and insurance. Important: W-2 employees cannot claim this deduction under current tax laws. It's not deductible. Number 7, home improvement and tax credits. While most home improvements aren't immediately deductible, they can still impact your taxes. Major upgrades like kitchen remodels, roof replacements, home additions increase your home's cost basis, reducing potential capital gains when you sell. Energy efficient upgrades like solar panels, efficient windows, HVAC systems qualify for a 30% federal tax credit, up to $3,200 per year. If improvements are medically necessary, such as wheelchair ramps or stair lifts, they may be deductible as medical expenses. Lastly, if you take out a home equity loan or HELOC, interest is only deductible if the funds were used for home improvements, not personal expense. The key to maximizing tax savings as a homeowner is good record keeping. Save all receipts for home improvements, mortgage interest, and property tax payments. Work with a tax professional to make sure you're getting every deduction that you qualify for.